Asset. Any resource or item of value owned by an individual or organization, such as property, stocks, or cash. Budget. A financial plan outlining income and expenses over a set period to manage money effectively. Equity. The ownership value of an asset after deducting liabilities, often referred to as net worth. Investment. The act of allocating money or resources with the expectation of generating a profit or return. Liability. A financial obligation or debt that an individual or organization owes to another party. Diversification. A risk management strategy that involves spreading investments across different financial instruments, industries, or other categories. Passive income. Earnings generated with minimal active involvement, such as rental income or dividends. Compound interest. Interest calculated on the initial principal and also on the accumulated interest of previous periods. Liquidity. The ease with which an asset can be converted into cash without affecting its market value. Return on investment. A performance measure used to evaluate the efficiency of an investment, expressed as a percentage. Capital gains. The profit realized when an asset is sold for more than its purchase price. Inflation. The rate at which the general level of prices for goods and services rises, eroding purchasing power. Financial independence. The state of having sufficient personal wealth to cover living expenses without actively working. Emergency fund. A savings account reserved for unforeseen expenses, such as medical bills or car repairs. Tax deduction. An expense that can be subtracted from taxable income to reduce the amount of taxes owed.
Net worth. The total value of all assets owned minus all liabilities owed. Credit score. A numerical expression representing an individual's creditworthiness, used by lenders to evaluate loan applications. Financial literacy. The ability to understand and effectively use financial skills, such as budgeting, investing, and saving. Expense ratio. The annual fee expressed as a percentage of an investment's value, charged by funds for management and operational expenses. Portfolio. A collection of financial investments, such as stocks, bonds, and real estate, held by an individual or organization. Dividends. A portion of a company's earnings distributed to shareholders as a reward for their investment. Debt consolidation. Combining multiple debts into a single loan with a lower interest rate or monthly payment. Crowdfunding. The practice of funding a project or venture by raising money from a large number of people, typically via online platforms. Mutual fund. A pool of money collected from many investors to invest in securities like stocks, bonds, and other assets. Dollar cost averaging. An investment strategy where a fixed amount of money is invested regularly, regardless of market conditions. Hedging. A risk management strategy used to offset potential losses in an investment by taking an opposite position in a related asset. Wealth management. A comprehensive approach to managing an individual's financial resources for long-term growth and stability. Tax bracket. A range of income subject to a specific tax rate under a progressive tax system. Stock market. A marketplace where stocks, equity securities, are bought and sold. It's where investors can buy shares in companies and potentially earn returns through dividends or capital gains. Cash flow. The movement of money in and out of a business or personal finances, typically from income and expenses. Positive cash flow is crucial for maintaining financial stability. Value investing. A strategy where investors look for undervalued stocks or assets with the potential for long-term growth, based on fundamental analysis. Stock split. When a company issues additional shares to shareholders, increasing the total number of shares but reducing the price per share without affecting the overall value. Tax planning. The process of strategizing to minimize tax liabilities through deductions, tax-deferred savings, and other methods. Inflation hedge. Investments or strategies designed to protect against inflation, such as investing in commodities, real estate, or inflation-protected securities. Debt-to-income ratio. A measurement of an individual's debt payments relative to their income. A lower ratio indicates better financial health and a higher ability to take on more debt. Risk management. The process of identifying, assessing, and mitigating financial risks in order to protect investments and minimize potential losses. Index fund. A type of mutual fund or exchange-traded fund, ETF, designed to replicate the performance of a specific market index, such as the S&P 500. Retirement fund. Money saved or invested to provide income after retirement. Estate planning. The process of organizing an individual's assets and legal affairs to ensure a smooth transfer of wealth to beneficiaries after death.